Welcome to my YouTube channel. In this video, we will talk about the top 10 investment strategies. 1. Analyze the market interest rates carefully. Interest rates, also known as market returns, are arguably the most essential metric in investing. Interest rates are usually the annual gains investors receive from various commodities like stocks and bonds. This metric determines the value of a given investment and incorporates potential risks tied to investing in it. Remember, the stock market always includes several inherent risks, including market volatility, inflation, liquidity, and general economic conditions in a given sector. These risks must be accounted for, with a corresponding reward to satisfy potential investors. After all, investment opportunities with higher risks must have higher potential returns. Interest rates are effectively the numerical representation of these added risks. However, it is naturally difficult to calculate the objective value of various risks associated with a given investment, and then convert it into an unbiased interest rate figure. 2. Consider investing in mutual funds. For potential investors who wish to ease into the investment industry or simply avoid spending too much energy on it, mutual funds could be a perfect solution. Mutual funds are financial instruments that aggregate a variety of investment assets like stocks, bonds, or commodities. They are managed by industry experts with extensive experience and expertise in the investment world. 3. Have ample cash reserves via high-yield savings accounts. While the world of investment is exciting and rewarding, it is always essential to have a plan B if the initial strategies don't work out. Full-time investors must have sufficient cash reserves for a variety of crucial needs. From adjusting investment strategies and expanding risk mitigation practices to having financial freedom, cash reserves can liberate investors and let them do business confidently. Keeping and expanding cash reserves can be achieved with a variety of strategies. For example, investors can put some of their resources into purchasing dividend stock assets. Dividend stocks are virtually the same as standard stocks, but with a single crucial distinction. They pay dividends to shareholders. Therefore, investors can generate additional cash income without actually shrinking their portfolios. 4. Diversify the investment portfolio. It goes without saying that investment is a risky endeavor in almost every case. Interested individuals and businesses must understand that investing in virtually any asset includes negative scenarios. Thus, it is always essential to have a reasonably diversified portfolio. While the extent of diversification depends on specific circumstances, asset allocation has become a necessity in the modern world of investing. 5. Stay calm even if the market panics. As a general rule of thumb, many industry experts advise exercising patience and perseverance when investing. Many investors make the mistake of responding instantly to certain market changes and downturns. In some cases, that might be the correct approach, but investors must stay patient and trust the overall process in many others. While certain market downturns are crippling, most price variations and volatility concerns are temporary and often precede lucrative appreciation. Therefore, it is crucial to see the bigger picture and have outstanding patience, not sell a stock when the market appears to be in chaos. Patience has served numerous investors very well empirically, and it continues to do so recently. 6. Consider a growth investing strategy. While the end game of investing is almost always making substantial profits, sometimes it is best to play the long game, prioritizing assets with growth potential instead of immediate income. Growth investing is one of the most promising alternative investments on the market. Usually, growth investing involves purchasing growth stocks from startups and other companies that are expected to grow tremendously in the future. As a result, investors can multiply their initial invested value in the long term. Growth investing is highly attractive to most investors, as it can potentially provide massive returns on limited investments. However, it is also a risky endeavor since most of the subject companies still need to be established or really tested. Therefore, many potentially lucrative growth stocks could become busts, not even delivering on their initial value. However, many investors are still ready to take this risk, considering the potential rewards if everything works out. 7. Understand the tax implications. As with every other industry, Taxation is the key element in the field of investing. Different investment markets, countries, and even geographical regions have varying tax rates that must be paid on time. Taxes effectively decrease the gross profits on an investment portfolio and therefore play a significant role in determining future investments. Investors must be mindful of tax rates before entering a given asset market, as they can heavily influence the net income remaining after all costs have been deducted. Different countries and sovereign entities have various types of taxation related to investment commodities. Taxation also depends on the type of assets purchased and held. For example, dividend stocks have a higher rate of taxation, as the investor actually receives the liquid profits. Conversely, growth stocks and other assets that prioritize appreciation can be taxed very lightly. 8. Master the risk mitigation practices. Last, but certainly not least, investors must always think about minimizing risks related to their portfolios. The risk mitigation practices can include the above-discussed diversification strategies, risk hedging, lowering the portfolio volatility, and more. There are no objective ways to ensure minimal risk, as specific investment circumstances require distinct risk management practices. 9. Passive and active strategies. The passive strategy involves buying and holding stocks and not frequently dealing in them to avoid higher transaction costs. They believe they cannot outperform the market due to its volatility. Hence, passive strategies tend to be less risky. On the other hand, active strategies involve frequent buying and selling. They believe they can outperform the market and can gain more returns than an average investor would. 10. Final takeaways. Becoming an investor is a challenging yet rewarding undertaking for individuals and businesses alike. Investing provides asset growth, reliable income, and security against inflation. However, investing can also be a highly risky endeavor that leads to sizable losses. For aspiring investors, it is crucial to study the basics, become familiar with investing tactics, and stay diligent every step of the way. Thus, for individuals and businesses aspiring to create a profitable investment portfolio, it is essential to get acquainted with fundamental concepts and understand the risks involved. While investing can be a highly profitable career, it demands dedication, energy, and time. Those willing to provide all three have a strong chance to succeed in the short and long term. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.